Good morning, everyone. Thank you for joining us. My name is Mark Henry, and I'm joined by my fellow practice leader of Citrin Cooperman's Manufacturing and Distribution Group, John Giordano. We're extremely proud to be reviewing the results of our 5th annual survey report with all of you. Polled over 200 owners and leaders of privately held businesses in the manufacturing and distribution space to get their insights into their biggest successes and challenges that they faced over the last 12 months, also focusing on their keys to growth in 2024. We're proud to have Dr. Anirban Basu back with us again to give his insights on the economy and specifically the results that came out of our newly issued survey. Dr. Basu is chairman and CEO of Sage Policy Group, a Baltimore-based economic and policy consultancy firm which he founded in 2004. He serves in the chief economist function in many organizations. He's the distinguished economist in residence at Goucher College, where he teaches history of economic thought. He holds 4 graduate degrees, including a JD and a PhD. Dr. Basu, thank you for joining us.
Righto, thanks a lot to let me share my screen with everyone so you can see the presentation and what we're talking about today, which is, of course, manufacturing and distribution. So thank you to Citrin Cooperman, of course, for creating this forum to talk about these kinds of issues. This is the Pulse Survey Report on economist perspective. You might ask the question, why does it have to be an economist perspective? I don't know. That's what they decide to do. So that's where we are right now. So let's begin. Let's talk about some of the major findings. And we actually got some data this morning from the Institute for Supply Management. Let's talk about some major findings. And actually, as I was mentioning, we received some data from the Institute for Supply Management this morning. And it suggested that at least the new orders component not looking so great. And I'll talk about that, the macroeconomics of the situation. But before I talk about that, let me talk about some of the data that came to us out of the survey. In fact, that's what I'm going to focus most of this morning's presentation on, is the actual survey results as opposed to the macroeconomy. And then we'll talk about the macroeconomy. And by the way, please, use this opportunity to ask your questions because I'd love to address those. I plan to speak for about 45 minutes and then try to address your questions. So just some major themes. So number one, inflation overtakes supply chain as the biggest challenge. Now, note that inflation is more of an issue if it's more difficult for a company, whether a distributor or a manufacturer, to pass along their cost increases. 41% of respondents say that their company's biggest challenge today is rising inflation. In 2023, that survey, the biggest challenge was supply chain. Now, supply chain is a big issue. 30% say your biggest issue is supply chain. Some say it's e-commerce pressure, including from the likes of Amazon, 27%. High cost of capital. We'll talk about interest rates later on this morning, on the fact that interest rates are still rising, at least some of the interest rates at which we transact. Advanced technology readiness. 27% of respondents have now fully implemented data analytics tools and processes. More than half of companies are using AI or machine learning for cognitive engagement, process automation, and cognitive insights. Now, that's important because if you're not doing those things, perhaps you should ask the question, why are we not doing those things? And then finally, where is the growth potential here? Well, obviously, it would help if the economy holds its own, but stability is needed for growth. 35% of respondents said that stabilization of supply chain is the biggest key to their company's future growth strategy. That was followed closely by utilizing best-in-class technology, stabilizing the workforce at 29%, entering new markets 29%, and introducing new products 28%. Now, let's look at some harder statistics. EBITDA and revenues, the green segments, with respect to every bar, these vertical bars, that signals significant growth. And then the yellow segment means some or modest growth. You can see EBITDA to the left, revenues to the right, and then the years 2021, 2022, 2023, and 2024. Let's look at EBITDA first. 49% said significant growth. That's enormous. Significant growth in earnings before interest and so on and so forth, but significant growth. If you look at the revenue side, same thing, 49%. Another 45% said some or modest growth, which means what? 94% saw growth. That speaks to a really strong economy. So if we talk about economic weakness, perhaps we're talking about that in the very near term, meaning the last couple of months. But if you look at the last period, year to date 2024 at least, it looks pretty strong as far as I can tell from the data. Now, one of the things that we saw throughout 2023, and 2023 was a lot about inventory adjustment. A lot of retailers, distributors, manufacturers came in 2023 with what they viewed to be uncomfortably high inventories. And the story was similar. What was the story? Look, we have such supply chain issues. I need to supply to my customers. They get mad when I can't supply to them. And when I do supply to them, it's often at very high prices because there's such scarce inventory out there. So let me order ahead some inventory. Let me get some inventory in. And then, that'll be great. The problem is the supply chains have improved. Inventory came flooding in, and all of a sudden, some firms found in 2023 they had excess inventory, and so they used that year to try to bring inventory down. Now, this is business inventories. This is not from the survey. This is from the Census Bureau. 3 flavors here: retailers in green, merchant wholesalers in the middle segment in blue, gray at the bottom is manufacturers. Based on Census Bureau data, actually have not seen much inventory reduction among retailers or manufacturers. Is all the middlemen and women, the distributors, the merchant wholesalers, which is interesting. But that means some retailers are still dealing with some inventory issues. You hear about all that all the time, by the way, whether it's Target or others. Some manufacturers perhaps as well, though those inventories are quite flat. But distributors actually have seen some fall off in inventory. Now, part of that, of course, is driven by what was a strong economy in 2023. U.S. economy expanded 2.5% last year. So that helped to bring down inventory because sales volume was quite good. E-commerce, of course, increasingly important. Now, this is a complicated slide, so let me walk you through this. You see that yellow segment at the top? So these are survey results for 4 years, 2021 through 2024. The yellow segment at the top gets to what percentage of firms tell us that their percentage of online sales is above 75%. So what percentage generate more than 3/4 of their sales online? The gray segment, 51 to 75%. The orange segment, 26 to 50%. And then the green at the bottom, these are people who generate, or firms that only generate less than 25% of their sales online. And you can see over time what's happened, that online sales have grown. Now, you take that for granted and say, of course that's true, Basu. That's not news to us. Fair enough. But you might remember during the pandemic, we saw this incredible volume of online sales. E-commerce gains market share. And there was a debate at that time whether or not after the pandemic, things would return to quote unquote normal. We haven't seen that, have we? It seems that the pandemic generated a real acceleration, a new normal in which online sales have taken off. So 57% of firms, at least in 2024, said, at least half of my sales are online. And that seems to be the new vehicle. Product performance continues to improve. So what does that mean? Products are selling. It's been a good economy. I have to admit to you, I've been surprised by that. I've been pretty pessimistic. And I am, as it turns out, one of the most pessimistic people you will ever encounter. Didn't have a girlfriend in high school. Didn't really have one in college. I'm from Baltimore. So I expect bad things to happen all the time. So when things work out, and they've worked out reasonably well post-pandemic, I'm surprised by that. But this again comes from the survey. Half of respondents said that their products performed much better in 2023 compared to 2022. That was up from 27% in the previous survey. Let me just say that again. We went from 27% saying their products perform better to 50%. 84% said products perform somewhat or much better, up from 82% in the previous survey. So, a lot of people, and again, this fits or comports neatly with EBITDA and revenues. Products performed, and again, all of this suggests a strong economy. And then, of course, what we just mentioned, distributors managed to bring down some of their inventories. So what are the drivers of these positive product performances? Well, let's talk about that. Primary reason that there was a positive change of product performance, improvements in supply chain, 30%. That really helped. Now, if all of a sudden, though, orders firms that put in previously are now being delivered, that can actually make it difficult to manage inventory, can't it? But improvement in demand for product, 25%, offsets that. Stabilization of product demand, 12%. The presence of Amazon and other e-commerce platforms, 12%. Ability to pass on inflation in inventory/supply costs, 11%. Introduced new product line, 10%. But the big mover here was supply chain, which brings me to this slide, and there's some irony here. So people are saying, hey, our most significant improvement has been supply chain. Well, what's your company's biggest challenge today? Number one, we talked about this, inflation, 41%. Supply chain is number two, 30%. So that seems to be, again, this upward potential for improved performance. Because if you see improvement in supply chain, guess what you also get? Less inflation. So a lot relates to this. Now, we'll talk about labor and other things, but what's your company's biggest challenge today? 47% said e-commerce pressures, loss of market share to companies like Amazon. High cost of capital. Well, yeah, we'll talk about interest rates. Rising interest rates, 23%, so on and so forth. So lots of challenges out there, but I would say if you look, we do this once a year. If we look at the past year, things look pretty decent. It's been a good year for many of you based on the survey data. That said, let's dig deeper into those biggest challenges: supply chain, inflation, and interest rates. So from the survey, 90% of respondents indicated that they have seen a stabilization of the supply chain in 2023. That's a big proportion, 90%. Might I remind you that the highest possible percentage is 100%. I hope you're aware of that. That is the highest possible proportion of respondents that can say yes or no to any particular question, 100%. It's the highest possible percentage, unless, of course, you talk about the Baltimore Ravens defense, which, as you know, gives 110%. But otherwise, so when you say 90% of respondents indicated that they have seen a stabilization of the supply chain, that's major. That was a phenomenon. That happened in 2023. Still, and again, the irony, disruptions to global supply chain have caused companies to diversify suppliers. And my guess is one of the things that you have suffered, some of you at least, is a loss of some business relationships, right? Because these stable relationships where you purchase from a particular supplier or you sold to a particular purchaser, all of a sudden, if that was not in inventory and the purchaser was not patient, they might look to a new vendor. There's been a lot of that, obviously. Now one hopes that with supply chain stabilizing, some of those historic relationships can be reforged. And I'm sure some of you are trying to do that. You've also changed where your products are sourced. You've reshored to the United States. And by the way, we got the construction spending data this morning at 10 a.m. Eastern Standard Time. Construction spending was weak, residential, non-residential. But where do we see strength again? Manufacturing-related construction, as lots of factories continue to be built in North America and the United States in particular, and outsourced manufacturing in 2023. Changes in response to supply chain struggles. In 2023, did your business need to change your supply chain by implementing any of the following steps? 52% said more diversification of suppliers. More diversification of suppliers. And that's what I mean to say those historic relationships, in some cases, might be falling apart. That makes me sad. Relationships fall apart, but you can understand why, because if it's about inventory, it's about different people suffering different supply chain issues. If it's about getting a part at a very specific moment in time quickly, so a construction project can be completed or whatever it has to be, what are you going to do? Changing where you source your products, 43%, outsourcing manufacturing, 36%, reshoring to the US, 30%. No change is expected to be made with respect to 2023, well, in history. Now, we talked about inflation. One of the other aspects of life, of course, is shipping costs. So back to macroeconomic data, this is not from the survey. The Baltic Dry Index, which, by the way, is one of my favorite leading indicators for the global economy. This is a reflection of the price of shipping major raw materials, such as metals, grains, and fossil fuels by sea. The point is, why is this a leading indicator for the global economy? Because when shipping costs are high, what does that mean? The ships are full of raw materials, and raw material transport ultimately translates into final goods manufacturing, production. So when the ships conversely are empty, it means fewer raw materials are being shipped around the world. That ultimately translates into less final production. So it's a leading indicator. Now, the scaling here is weird because it goes from 0 to 6,000 on that vertical axis. And it goes up there because we had that huge increase in shipping costs during the pandemic. And you can see that spike above 5,000. If you look at the data carefully, you can see that shipping costs are starting to rise again quite significantly over the past year. On and off, but there, generally speaking, has been an upward trajectory. Again, Panama Canal, Suez Canal, Red Sea, Houthi rebels, Somali pirates, shipping insurance costs, all those kinds of things are driving up costs. So people want supply chain improvement. They want less inflation. This pushes in the wrong direction, these higher shipping costs. And again, a lot of that has to do with geopolitics. So let's talk about that. Rising inflation was cited as the biggest challenge by 41% of respondents. 2/3 of respondents, 64%, experienced an increase in the cost of carrying inventory over the last 12 months. 73% of respondents anticipate that the cost of inventory will be higher in the next 12 months. Let's back up a little bit. The economy has been strong. Demand has been good. What's the issue here? Will the demand stay strong enough to offset some of these costs? Right? Cost of carrying inventory, cost of shipping. Almost 9% of respondents said labor costs increased last year. Labor costs on top of that. 43% said labor costs significantly increased. 45% said modestly, but not quite half said my labor costs are still rising rapidly. And of course, 2023 was a year during which labor flexes musculature. So we saw strikes among actors and writers. We saw strikes. And by the way, that's why you don't have a summer blockbuster. And last summer we had Barbenheimer, right? Barbie and Oppenheimer. Nothing like that this year because we didn't generate as much content because actors and writers were on strike. UAW members. Now, some negotiations did not end in strikes. Let me give you an example. The negotiations between UPS, United Parcel Service, and the Teamsters Union, that resulted in a 5-year contract. During the 5th year of that contract, the average full-time UPS truck driver will be earning $170,000 per year. That's $170K. That's wages plus benefits, but it's $170K. Forcing people like myself to ask the question, how do I look in brown? And based on the app, spectacular. But the point is, it's $170K. So those labor costs keep rising. High cost of capital was cited as the biggest challenge facing the company by 25% of respondents, and rising interest rates were cited as the biggest challenge by 23%. Capital investment costs were cited as a hurdle to reshoring by 46% of respondents. So again, there are many who would like to bring more production to America, but that takes capital investment. That capital investment often is financed. That implicates interest rates. Interest rates are high, at least relative to what they had been in prior years. So all these things moved in the wrong direction, as it turns out. And yet, many of you said that your EBITDA was stronger, your revenue is stronger. It's a very strong economy. It has been. It has to stay strong to offset these costs. Otherwise, EBITDA and revenues won't continue to rise. Now, all manufacturing industries, this is a producer price index. It's a measure of inflation. It's a reflection of what manufacturers are receiving for their product. Right? What sellers, manufacturers receiving for their product. And we're talking about US manufacturers. Right? So you look at the green line, you look at okay, Anirban. So this is a measure of inflation. It is. What's been the year-over-year percentage change in the producer price index for manufacturers? 1.2%. And what that says to me is there's some question out there about this pricing power. So manufacturers and others have had this pricing power, but it seems to be softening up. And maybe, again, that's because the economy is softening up. Now, you may disagree. We can talk about that during Q&A. Again, I'm a pessimist. Now, there's the consumer price index, another measure of inflation. This is 12% change in consumer prices. Okay. So what's going on here? You look at that green line there, that's the overall rate of inflation. And between April of 2023 and April of 2024, inflation ran at 3.4%. That's what this says. If you look at the dark blue line there, that's the so-called core consumer price index, all lines as food and energy. That's saying inflation running at 3.6%. Fine. You look at that and say, okay, inflation's coming down. But if you look at the green line, again, that overall consumer price index, It's stubbornly high. Do you see how it stopped falling? In June of 2022, it's 9.1%. So it came down that mountain quite quickly. But then it's sort of stuck above that Federal Reserve's 2% target. And it's just stuck overall. So how does a firm manage product costs? We're in this inflation environment. And, with workers still becoming more expensive, supply chain issues around the world still apparent, and costs are going to continue to rise. That's what this is saying. That's what the survey results are saying. So what can you do? Which of the following are ways you're managing your cost of product? Select all that apply. Manufacture more product ourselves. Right. Exactly. We have fewer relationships then. We internalize, vertically integrate, renegotiating forward contracts for purchases, raising sales prices. Well, of course, that's part of the inflationary dynamic. Renegotiating freight contracts, outsourcing more manufacturing to third parties. Okay, well, that's different. That's the opposite. So very different responses here, isn't it? Or aren't they? Manufacturing more products ourselves, some people, but almost an equal fraction saying we're outsourcing more manufacturing to third parties. Let somebody else do it. They're better at it. Relocating sources closer to consumers, 38%, none of these, 1%. Now, the economy has been strong enough thus far, according to the survey at least, such that companies are still able to pass along their cost to customers. So again, this is from the survey. How often are you passing production, supply chain, and other inflationary costs to your customers through raising your prices? Okay. The green color bar 2023 survey, yellow colored bar 2024 survey. A quarter of you are passing along your price increases every month. A quarter of you. Another 46% are doing it quarterly, which means 70% of you are doing this at least once every 3 months. Almost all companies are passing costs to customers. But again, to do that, the economy has to remain strong enough. It has to be worth the while of the customer to bear that cost increase, whether they're a final consumer or whether they're an intermediary player. Companies appear to be passing production prices on to customers less frequently than last year's survey. So in 2023, you can see the numbers were 19% monthly and 65% quarterly. That adds up to 84%. So maybe that's what? Maybe some reflection of some improvement at the margin, at least, in the supply chain. 70% are passing production and added supply chain costs to the customers through raising prices at least quarterly, down from 84% in the previous survey. Now let's talk further about the impact of inflation interest rates. Please tell me how much you agree or disagree with each of the following statements in relation to the impact of inflation or rising costs on your business. Let's look at the left-hand columns here, the two. Inflation. So the green segment there says you somewhat or strongly agree with the statement. So 81% somewhat or strongly agree with the following statement. The current inflation environment has impacted my business's spending habits, 81%. So you're trying to avoid this inflation on your cost. Of course you are. Consumers try to do the same thing. Fine, but it's still a driving phenomenon in your business operations. 61% say the following. My business anticipates our customer spending to slow in 2024 as a result of inflation. Hold up. What's that? This is fodder for the pessimist. But here's the point. Here's the point. So what have we said so far? Costs are still rising. The customer, the consumer, is being impacted by these rising costs. They might be running out of some momentum. The US economy might be running out of some momentum. None of that's good for EBITDA. I mean, whatever it does on revenues, it does. But in terms of earnings, if costs are rising faster than revenues, that's problematic or could become that. Again, a lot of you have said thus far, EBITDA and revenues have been fine. Don't get me wrong. I'm trying to be prospective here, looking forward. 70% of you, 76% of you, sorry, say the current interest rate environment has impacted my business's spending habits. 76%. So these interest rates try to have a bite. And often it's said that it takes about 2 years before higher interest rates really have an impact on the economy. Well, the Federal Reserve started raising interest rates on March 16th of 2022. So 2 years and 2 months ago, roughly. And so now we're starting to see these interest rates, these higher interest rates, maybe have some bite, take the sort of the juice out of this economy. 61% agree with the following statement: my business anticipates our customer spending to slow in 2024 as a result of interest rates. So, if you look at the forward-looking indicators, they're not nearly as positive. Let's talk about some more negativity, shall we? Again, I'm an economist. I mean, that's what I'm going to be. I'm going to be negative. They call us dismal scientists for a reason. I mean, anyway. So companies facing labor shortages and increased labor costs. So more than a third of respondents report facing labor shortages. And I got to tell you, the competition, not just between firms within an industry, but between industries for human capital is fierce. Let's go back to that UPS truck driver. I do not begrudge that UPS driver that level of compensation. These are very special people. They have to be able to lift heavy objects. They have to be able to drive a large vehicle. They have to be able to park that vehicle. And they have to pass a drug test. Most Americans cannot do all of those things. But, many manufacturing workers can do those things. They can drive large vehicles, they can park them, they can lift heavy objects, they can pass a drug test. So, same thing with construction workers. Lots of competition for human capital. So that suggests that wage pressures continue to be in place. Which is, again, why I'm skeptical that we're going to quickly return to 2% inflation, the Federal Reserve's target. That labor market is too strong. And then again, we have these burgeoning supply chain issues out there. Again, Panama Canal, Red Sea, so on and so forth. The increase in labor costs was split evenly between salary and health benefits. 45% said salary was the most significant portion of increased labor costs. 45% said health benefits, the most significant portion. Whatever, compensation is compensation, and it is rising. So which areas of the business are most impacted by these labor shortages or human capital shortfalls? Skilled labor. Of course, one of the things that we've seen in America is this massive in-migration. Many undocumented migrants. Not going to get into the controversy around that, but it has added to the supply of workers. But do those folks coming across the board necessarily have the skills that individual manufacturers, distributors need? Logistical specialists, etc. Well, you can see here which areas of the business are most impacted by the labor shortage. 62%. Warehouse, 47%. So, it sounds still like a pretty strong labor market, of course, a fairly strong economy. Now, one of the ways to offset the cost of labor is by enhancing productivity. Now, sometimes enhancing productivity means making each individual worker more productive, more output per hour worked, but sometimes it means displacing the worker by a piece of capital. So let's talk about some advanced technology. So 27% of respondents have now fully implemented data analytics tools and processes, and another 43% are currently implementing data analytics tools and processes. So again, if you're not doing that, if you've not completed full implementation, as 27% have, or if you're not currently implementing, as another 43% have, then you are part of the 30% that isn't on this road yet. And you have to ask the question, why is that? More than half of companies surveyed are using data analytics to improve efficiency of product sourcing. That's 65%. Improve the profitability of products, 65%. Better understand buyer behavior of products and services. We'll come back to that in a second, 58%. Better predict timing of product demand, 54%. Better predict geographic location of product demand at 53%. So a lot of this is not about just improving efficiency of output, production, distribution, but trying to figure out what the consumer wants at the end of the day and how that's going to change. The top factors for successful implementation of data analytics tools and processes are buy-in and support from leadership and ensuring the appropriate tools are in place. Artificial intelligence can't get over. I've not given a presentation this year during which I haven't mentioned artificial intelligence. I just have to, everyone has to, and machine learning, ML. So manufacturing distribution companies are currently using AI/machine learning for cognitive engagement, customer service intelligence agents, internal sites for employees, product and service recommendation systems. But customer service, again, process automation, 64%, using robotic processes for administrative and financial activities. My goodness. I mean, we are creating a species superior to our own, right? Between artificial intelligence, which is smarter than us, and the robots, which are stronger than us and don't take off weekends, even 3-day weekends, this has got to, but of course, some companies are going to be in the vanguard of AI or in the vanguard of machine learning or both. And one suspects that they might end up being the most profitable. Now, many of those firms, as it turns out, are already among the largest firms. So they have the balance sheet necessary to buy the equipment, to train the workforce. So, it seems to me that life for smaller manufacturers can become more difficult when you've got this kind of technological transformation. But again, if you disagree with that, we can take that up during Q&A. Cognitive insight, using algorithms, 53%, to detect patterns in data and interpret their meaning. Most common business functions where AI is being used: IT, 7%, inventory management, 53%, and quality control, 51%. Let's talk about this some more. Effect on headcount. 32% say AI has resulted in a reduced headcount. Let me back up. A third of you have said that AI, which seemingly has come out of nowhere just in the last few days, but already apparently the use cases are sufficient, that 32% of you say it's resulted in reduced headcount, which of course necessitates some other invention. So if you can't find enough workers, and AI is a tool to help deal with that issue by reducing the demand for workers, one wonders what this means for the economic cycle. Will the labor market start to slow down in part as AI takes over more jobs? 34% say that they have altered job competency and repurposed staff, maximize investment value. Only 44% say they have the reporting and analytical capabilities to evaluate and maximize the value of current and future intelligent automation investments. They don't know. How do you evaluate the impact of this automation? And maybe AI helps with that. Top barriers: preventing companies from implementing or expanding use of AI/machine learning, integration with existing systems, right? You got a lot of fixed capital out there. And it can't necessarily talk to the new machinery, and quality of data in current systems. So applying AI for advantage, and that's what you're thinking about, some of you, right? Some of the time, at least. How can I make AI an advantage for me, at least relative to my customers? How can I, sorry, not my customers, relative to my competitors? We love our customers. We hate our competitors. I mean, I'm a small business owner myself. So, okay, how has artificial intelligence or machine learning benefited, your company? Given us ability to gather and utilize data outside of our company. Oh, that's interesting, right? If the supply chain is the problem, if it's my integration or lack thereof with others, including those who supply me, or to whom I'm selling, my customers, and I'm trying to figure out where they're headed, my customers, in terms of demand for my products, or where that demand is growing fastest geographically, AI is giving people, insight into those things. Can you imagine a firm that has that kind of insight and firms that don't? What we're saying is that's the difference between firms that are using AI, I mean, to a certain extent, and firms that aren't. Given us ability, 63% said, given us ability to predict events, maintenance issues, quality issues, employee behaviors. That's an interesting one. How do you predict that? Employee behaviors. I'm not sure about that one, but I mean, I guess if you see someone drinking heavily on the job, you can say, hey, something interesting is about to happen, but that's I don't think that's AI. Given us the ability to predict customer behaviors, that's interesting, 53%, right? I mean, that's at the core of inventory management. If I can know what my customer is going to buy, then I'm not going to have these issues of, or to a less extent, not going to have these issues of excess inventory in some categories and inadequate inventory in others. I'm going to be closer to equilibrium. It has automated some repetitive tasks. So what's the outlook? So give me 9 more minutes and then we'll go to Q&A. Continued expansion, need for stability, data analytics to stay competitive. I think what this gets at, before I get to the outlook, is how quickly things are changing. For you, not for me. I'm an economist. Things never change for us. I don't have a license to practice. I'm not held accountable for anything I do, but you are. And so we want to think about that, right? So what are the expansion expectations? Now, I've been quite glum about the economic outlook, haven't I? You've sort of picked that up, right? Which of the following, if any, do you anticipate occurring for your business over the next 3 years? Capital investment involving improvements, buildings, and equipment exceeding 200,000. 51% of you, you're still in growth mode. You're still investing capital. That's over the next 3 years. There might be a presumption here among many of you that at some point in the next 3 years, interest rates will be far lower, and that some of you have postponed certain capital projects or investments because you're waiting for those low interest rates. So it may be frustrating to you that interest rates have stayed higher for longer, sorry, and appear poised to remain that way. Now, here's the big one. 39% say significant increase in your workforce. Wow. So here I am being, this pessimist. But 39% of you, basically 2 in 5 are saying we're going to significantly increase our workforce. Yeah, there's AI, there's robotics, and that's going to bolster productivity. But we're going to have enough demand growth for our products that we're going to increase our workforce. A potential expansion of the business to a new facility or plant, 37%. That doesn't sound like stagnation. Entering new states, 35%. Ditto. An acquisition of another business operation, 29%. Absolutely. That's not stagnation. That's a lot of deal flow. That's just 3 years. 30% of you basically are saying, hey, we're going to acquire another business operation. The next 3 years. Significant decrease in workforce, 20%. Well, that's interesting, because that goes in the other direction. Now, it's half the proportion saying significant increase in workforce, but still, business are changing out there. Now, why are they decreasing the workforce? Why do they expect the next 3 years? Are they thinking recession? Is it macroeconomic forces? Or is it because they're changing their business so that they don't need as many workers? And ultimately, will the firms that are seeking to increase or expect to increase their workforce going to be more successful in terms of profitability than those decreasing their workforce? That'll be interesting to watch. Sale of business, 19%. Reduction of office space, 14%. Hurdles to reshoring, we've mentioned this very briefly, but let's talk about this a little bit more. Which of the following do you feel are hurdles to reshoring? Now, the yellow colored bar here is 2023, green colored bar is 2024. Lack of meaningful tax incentives, 2024 survey, 36% said that's an issue. We need tax incentives. Might have fixed capital someplace else. You have to divorce yourself from some of that fixed capital or all of it. You also have to invest in fixed capital in the United States of America. And so that can be a hurdle to reshoring, right? Tax incentives offset many costs, including, by the way, the cost of higher interest rates. Lack of access to skilled labor, that's a big one, 38%. We can do something about this in this country, right? Creating the blue-collar technical workforce of the 21st century. If we did that, we're off to the races. Capital investment costs, 46%. Well, of course, interest rates are high. So I'm talking about the 2024 survey now, the green-colored bars. Capital investment costs, 46%. Of course, it's hurdle. Cost of U.S. labor, 50%, but that's down from the 2023 survey. As you know, the Chinese workforce and other workforces around the world have become much more expensive. Still not as expensive as America's workforce, but nonetheless, the gap has closed to a certain extent. So cost of labor is still very much a factor here, but it has become less so with the last survey. Keys to growth. So let's talk about some more Pulse survey data. From the following list, which are the biggest keys to your future growth strategy? Stabilization of supply chain. That's what you need. And some of that you control, some of it you don't. So that's interesting. But, when you stabilize the supply chain, very good things happen. One, of course, is you get more transactional volume, more predictable transactional volume. That translates to economic growth. But also you get less inflation because there's less scarcity in the economy. Right? Shorter waits, construction projects get finished earlier, that kind of thing. Utilizing best-in-class technology, 33%. That's interesting, because it's just not clear, what that translates into. Utilizing best-in-class technology. What is it when technology changes so quickly? Stable workforce, 29%. Enter new markets, 29%. New products, 28%. Not about necessarily new products so much. It's about stabilization of supply chain for existing products, perhaps. E-commerce, 23%. Mergers, acquisitions, 19%. Staying competitive. Again, for the Pulse survey, which of the following do you believe is needed now or in the near future to keep your company competitive? 68%. So whenever you see a 68% response, you got to pay attention. The ability to gather and analyze data from suppliers' ERP systems to better predict supply chain delays and cost challenges. Wow. To go outside of the company, look what your suppliers' systems are saying about their issues in terms of supplying you. 68%. The ability to gather and analyze customer data to better predict their behaviors. Now, one of these things that this implicates, of course, is integration. integration between you and your customer, integration between you and your supplier. That requires trust. That might require attorneys, right, to share data, to share systems. And that can be a real hurdle. The ability to identify when employees are at risk of leaving my company, 50%, wow. I guess, I mean, the way I do it, I just look at their emails, but I guess there must be better ways to do that. So stabilization of inflation, stabilization of interest rates, yeah, we'd all love to see that. And I think there's a presumption that we'll begin to see that later this year and in 2025. That should help. Our company currently has the systems in place to keep us competitive. 33%, we're good. The 30 of you said, hey, we're fine. Now, let me talk about some lead economic indicators here. So, I'm hinting at this pessimism. Shouldn't take that too seriously because that's just who I am. That's who I am. So, but this is a Conference Board's index of lead economic indicators. So there's actually 10 lead indicators all bundled in one composite index. It's an index that predicted the 2001 recession, predicted 07, 08, 09. It's not telling us something more wicked this way comes. And my thesis is that this is a function of those higher interest rates that are finally starting to erode parts of the economy that have been performing well, particularly the consumer sector. I don't know if you looked at Friday's data, right? The PCE data, personal consumption expenditure data, indicating that last month, if you adjust for inflation, consumer spending was down in America, down, once you adjust for inflation. Today, we got the ISM report, not a good number, below 50. New orders were weak. The yield curve is still inverted. I won't go through all of this, but the green line is the yield or the interest rate on the 1-year U.S. Treasury. The dark blue line is the yield or the interest rate on the 10-year U.S. Treasury. Now, typically, you'd expect the yield or the interest rate on a 10-year instrument to be materially above that relative to a 1-year, right? Because you're buying a Treasury for 10 years. If you hold that bond to maturity, you're going to see your principal for a decade. So you demand higher interest from the marketplace. But occasionally, the bond market goes topsy-turvy, upside down, inside out, Diana Ross. And the yield on the 1-year goes above the yield on the 10-year. That's an example of an inverted yield curve. It's been inverted since July of 2022. The gray shade areas here are periods of recession dating back several decades. So when you see that green line go above the blue line, just before the 1970 recession, before 73, 74, 75, before 1980, before 81, 82, before the 1990, 1991 episode, before 2001, before 07, 08, 09, not so much before 2020, that was caused something else, as you know. But now I've got this inverted yield curve. As we're a pretty flawless predictor of recession for decades. So, look, what's my outlook? And again, I am a pessimist, and I was wrong about 2023. 2023 was a much better year economically than I predicted, especially the back half of the year. And, this is a quarter during which the U.S. economy is on pace to grow more than 3% on an annualized basis, right? So we saw weak inventory investment the first quarter. Inventory is expected to rebuild a bit in the second quarter. That adds to GDP, economic growth. But we are a deeply indebted society currently facing high borrowing costs, and that's what makes me pessimistic regarding the near-term outlook. Of course, we've got all kinds of geopolitics all over the place, and we've got federal elections. That's incontrovertible. And a lot of decision makers embrace wait-and-see attitudes during years of presidential elections. Let me give you an example. So, look, we're facing, for instance, the expiration of $3 trillion in tax cuts next year. Now, I'm not saying that's good or bad. That's for you to decide. But you can imagine that a major business decision maker would want to know what the tax code is going to look like before they pull the trigger on a big decision. Sometimes people will postpone even small decisions. Let me give you an example. Honey, we need a water heater. Hey, let's see how Trump does before we make that kind of commitment, or Biden, whomever. But the point is that could further suppress growth later this year. So it'll come nearly a year after initially anticipated. But I think recession is coming either very, 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 very late this year or in 2025. Of course, I could be wrong about that. If it doesn't happen in 2024, 2025, I'll predict recession for 2026. And if that doesn't happen, I'll predict one for 2027. You say, why? Anirban, why are you being so stubborn about it? Because eventually I'm going to be right. And then I can retire. And people will say, oh, that Basu, boy, did he know the economy? He could forecast, couldn't he? I miss him. But then the other thing is we have some significant imbalances in the economy between the office market, the exposure of the banking system to that, and consumers starting to slow down and take in lots of credit card debt, and they just cannot continue to spend as they have been. At least that's my thesis. With that, let's go to Q&A. Thanks a lot for the opportunity, everyone. Let's go to Q&A.
Dr. Basu, thank you again for joining us this year on our survey results. Always insightful and always entertaining. working through you with this. So I think right now, after the presentation, we'd like to open up for some Q&A. Would be best to just post it through the Q&A chat box on the bottom of your screens there. In the meantime, while that's being populated, we do have a couple questions here. One of which you mentioned policy and things that are getting stalled and whatnot. But I think, as tax practitioners and accountants, nonetheless, one of the big things is the research and development. That policy that's out there was a big change for manufacturing companies. It seems to still be stalled in Congress. Have you heard anything in terms of any movement or any traction?
Well, I would say yes. I mean, yes and no. So we have a presidential election in front of us. Hard to get anything done right now, but there is significant bipartisan support for R&D tax credits as part, and that's one of the things that both Democrats and Republicans share, which is a commitment to reshoring. And along that dimension, whether it's President Biden or former President Donald Trump, they agree on this. They want to see more of these tax credits. They're fine to wrap this into the national debt, which is now approaching $35 trillion, but they're fine because they want to reshore more production, whether it's in Scranton, Pennsylvania, or wherever it happens to be. So I think you will see progress. I don't think you'll necessarily get anything done before the election. They can surprise me because they want the people in Congress want to be reelected too. And a really good thing to do is to say, hey, we're still making progress here. We're still working together. R&D tax credit is one of the things I think that if anything could get done, that might be it.
Okay, thank you. We do have one question that came in. Where do you see ocean freight environment heading in the next year?
Yeah, I would think that it'll get better. And why am I saying that? Because there have been so many orders for ships that have, now are under construction, yet to hit the 7 seas, but they're under construction. And so as that shipping capacity increases, that should improve things in terms of shipping costs, at least. Now, one thing we don't know about is geopolitics. So Taiwan Strait, Suez Canal, Panama Canal, all that, I mean, when you've got, the Iranians and the Israelis exchanging fire, all these kinds of things, even the Iranians and the Pakistanis actually recently, which didn't get much attention here, but did in other parts of the world, it's a very fraught situation. But if you just look at the laws of supply and demand, one would think that there's been such an emphasis on, shipping capacity that a lot of several years ago ships were ordered, they're about to be delivered, and that should help, all things being equal.
Okay. One other question that came in that was answered was regarding the presentation and whether or not it will be available. The recording of the webinar will be sent out to all the webinar registrants, so you could be on the look at that from our marketing team here. We'll get that out to everybody that's registered for today. Another question regarding, I guess, policy again. Are there any other current government policies out there that might not be grabbing front page headlines, but could have an impact on the economy?
Oh, gosh, yes. It should be grabbing headlines. But one of the reasons we have so much inflation is because, and I'm not being partisan here, because as you know, the House is controlled by Republicans, the Senate and the presidency by Democrats. So these are bipartisan outcomes. But one could have predicted that federal spending would increase during a crisis like COVID. There'd be paycheck protection and stimulus payments and so on and so forth. And, an effort to finance research and development to find a vaccine and so on and so forth, whether from Moderna or Pfizer or whomever. Okay. I don't think that it could have been predicted that level of spending would not fall, that the federal government will keep spending as if the crisis is still in place. And that's one of the reasons that aggregate demand has been so strong, is because even as the Federal Reserve, the monetary policymakers have been seeking to slow the economy, the federal government, through its spending, and to a certain extent by previous tax cuts being implemented, have been accelerating economic growth. They're, working in a different direction. And that's helped to keep inflation stubbornly high, as it turns out. We are starting to see in the data, just recently, and this is not captured a lot of headlines, some slowing of federal government spending growth. Some of the pandemic era legislation has worked its course. Some of those programs are being retired now. And so as a result, if we continue to see that, and if consumers start to slow down their spending a bit more than we've seen thus far. But we're starting to see some signs there of wear and tear on the American household, particularly that 50% of Americans who don't have much wealth. Watch out. I mean, that's why I say recession is possible, is because some of these sources of aggregate demand are starting to wear thin.
We have another question from an anonymous attendee, and this actually, I really appreciate this question because I think it's pretty valid out there. How does a small business learn about the opportunities in AI? Obviously, these larger companies have the wherewithal and the spend to be able to make such types of investments, but what about the small business owner? How do they learn more about it, and how do they go about looking for ways to implement that into their business?
Here's the good news about that. I mean, it's a tough one. Because if the question is, how do you learn about AI opportunities? Well, those opportunities are available. And one of the things I do a fair amount of public speaking, and sometimes I'm in person. I'll be in Tampa tomorrow, for instance, in person. I'll be part of an agenda. And it's become very popular at conferences for there to be a speaker about artificial intelligence on the agenda. And I've now seen dozens of them. And, all of them are speculating about what the effect of this will be on the economy, but they're also trying to work very hard for audience members to help them understand the use cases. How can AI be relevant to you? Now, that's one issue. So there's no reason that a small business can't be aware of the opportunities. What's the challenge here? Sometimes you need scale to implement the opportunity, right? You need that piece of equipment. You need to be able to train workers. You need that expert on your staff with respect to AI. And obviously, large firms have an advantage accumulating those resources. But in terms of learning opportunities, my goodness, there is no shortage of speakers out there on the speaking circuit talking about artificial intelligence. And so that's the first place I'd start. Just go to some conferences to find out what people are saying and see if you can find that speaker who says, oh, something that really is relevant to your business, and then go up to them afterwards and say, hey, can we talk some more? And that's what I would say in terms of learning about the opportunities.
Okay, thank you. Here's a question that shifts to inflation. So with inflation stuck above 2%, when do you anticipate it, or will it ever get to the 2% target? Why would the Fed lower rates when inflation is still where it is at?
That's a great question. Sorry, but that's a great question, because the Federal Reserve clearly, at least Jerome Powell, our chair, they want to cut rates. He's a bit of a dove. He wants to let the economy go. But they're not at 2%. The data, for the most part, this year have come in hotter than anticipated on the inflation front, whether consumer price index data or other data. We got actually for April, we got a benign data point on inflation in April, and so consumer price index data. And so the market took off. That's when the Dow Jones went above 40,000. Got one benign number on inflation, but generally speaking, the inflation data have not been particularly good. Why? Because they're reflecting wage pressures that are ongoing and supply chain, which is still problematic in many ways. So I wouldn't expect 2% inflation anytime soon. If they tell me, these Federal Reserve policymakers, we're data dependent, and you're looking at the inflation data, you have no reason or even right now to cut rates. And in fact, there's some economists who think that the next move by the Federal Reserve will be to raise rates. I don't think that's likely. I think you'll get 1 or 2 rate cuts later this year, but watch these inflation data, because supply chain issues and labor market are enough to keep prices rising too rapidly.
Thank you. We did mention that we will be circulating the recording here. There's a question also about whether the deck will be distributed. I believe it will be to the same group of participants that are registered here today. And then we do have another question on, seems the ambitious outlook for 2024. So the question is, how did EBITDA and revenue from 2021 through 2023 align with the survey data? So the respondents that respond, the question we typically pose to them, whether or not it was met or not met in terms of their projections and their budgets. So we'd actually have to go back and pull the data on those to get back, unless you have any other insight, Dr. Basu.
No, I did not present the data on the expectations. I presented the data on whether or not, in fact, EBITDA and revenues grew. And again, in the 2024 survey, 93% said they grew, 49% said significant in terms of EBITDA, and 94% in terms of revenue said grew, and 49% said significant growth in terms of revenue. So no insights beyond that, but it seems as if performance to this moment in economic history has been rather solid.
Okay, at the moment, I don't see any other open questions. We are a few minutes before the hour. If anybody has another question to pop through, otherwise we'll start to close out here. So I think, Mark, if you want to rejoin here, we could kind of close out.
Well, Dr. Basu, thank you for joining us, and John, obviously, thank you for moderating the question and answer section. This is our 5th year doing this. I think we've got a lot of meaningful trend analysis here. If anyone has questions, feel free to reach out to any one of us. We'd be happy to answer more questions. Thank you for joining us today. Bye, everyone.